Hi, I'm Peter Reznicek from ShadowTrader.net, and welcome to this short video titled How to Read the Market. A lot of traders, especially newer traders, put too much focus on price action itself or patterns in the market on different time frames and charts, but they don't spend any time looking what I call under the hood at the underpinnings of what's going on in the market for the things that are the actual drivers of price action itself. What are the things underneath the hood that you don't see in the price chart that are actually making the S&P or the NASDAQ go up and down at that moment? So that's what this video is about. I'm going to show you an overview of what I look at every single day during the day in order to read the market successfully. I look at a lot of different factors that all kind of come together as one, and that gives me so much market generating information that I need to make good decisions in the market at the right time, but more importantly also to not make bad decisions, to not just allow myself to be sucked in by price action and a good-looking pattern if the underpinnings aren't really confirming that pattern, because those are the types of patterns that tend to fail and cause losses in the markets. So without further ado, let's get into it. So I'm going to assume that this is probably not what you were expecting to see in terms of a chart flipped on its side like this. But if you look at this picture here, you can see this is a photograph of my entire setup, and you'll see that this chart that you're looking at right now is purposely turned this way in a portrait manner, and it's purposely on the left side of the screen. It's on the far left because I want to read the market from left to right, and I want to be looking at this screen first. And this screen, which I'm about to explain to you, is really the bedrock of how I look at the markets and how I figure out whether things are bullish or bearish. And then that gives me the information as to when it is time for an entry or not. So let's just look at some of this stuff from the top here. There's a lot of information here to parse, certainly. So let's get into it from top to bottom. Starting in the upper left, these boxes here are market internal boxes that are for breadth. This one is the breadth on the New York Stock Exchange, and this one is the breadth on the NASDAQ. So what does that mean? It's the relationship between the up volume versus down volume on that particular exchange. So what this is telling us right now is that down volume is running about 2.66 times the amount of up volume. So that means that volume that is flowing into stocks that are below the prior day's close, those would be considered down stocks. And then that particular volume is 2.66 times the volume that's going into stocks that are up. And on the NASDAQ, you can see it's pretty close to parity. That just in and of itself gives you a lot of information. Just the fact that it's so much stronger, it's close to parity at 1.03 to 1. So there's just a slight edge in down volume there. The next two boxes are for advancers versus decliners. And this is also measured at the exchange level. So you can see here that right now stocks that are down, there's 1,047 more stocks that are below the prior day's close on the New York Stock Exchange, but there's only 935 that are below on the NASDAQ. And then these two boxes are just simply a percentage away from 8-period exponential moving average and 21-period exponential moving average as measured on this particular chart, which is a 30-minute. So my top chart is always a 30-minute, and it is cash as well and not futures. And I feel that's a huge part of good technical analysis, I think, which is really important, is to look at markets that are only trading during regular trading hours only, and more importantly, where is the actual money and ideas and flow being committed to? It's happening in the cash market, certainly not in an overnight futures market on a 24-hour chart. It's really on the cash market, which only operates from 9:30 to 4 p.m. So I'm a big believer that the best TA in terms of technical analysis and even just short-term sort of prediction of where the market's going is going to happen on these cash markets. So I start with a 30-minute S&P, and as I was saying, these two percentages here are distance away from the 8-period moving average, which is right here, and this one is the 21-period moving average. So they're 8 and 21, and they're both EMA. They're both exponential and not simple. And I'm a big believer that these really make a big difference. So right now you can see that prices are very close to the 8 and the 21. They're just kind of intertwined. So it's not really telling you all that much. Basically, if the 8 is above the 21, the market is much more bullish. If the market is below the 21, as it is here, it's a little bit more bearish. Okay, Now, here's where things really start to shine in terms of really getting a feel for what the market is doing. This is really, really important. The boxes that you see down here below, these are the 11 sectors that make up the S&P 500. So the cash market, which is the chart above, is driven completely and solely by these 11 sectors and nothing else. The S&P 500 only has these 11 groups. There's obviously hundreds of little subgroups. You can get more and more granular as you go. But these are the 11 sectors that comprise the market. As you can see from here, from left to right, they are technology, healthcare, financials, consumer discretionary, industrial, communications, consumer staples, energy, utilities, materials, and real estate. But what's very important about these sectors is the fact that they all have different weights. They're not equal weighted. So if something happens in technology stocks, for instance, that matters a lot more to the S&P. You can think of it as that it moves it more, right, in an up or down manner when these stocks move, because these stocks take up 28% of the entire index. 28% of the index is made up of tech, and healthcare is 13.7. So you can see here that just together, these two sectors are 40% of the S&P, and that's important to note. I'll touch upon that a little bit later on. And as we go further on down the chain, from 1 down to 11, you can see that the weights get progressively less. So I have all of these arranged in order of their weights. So healthcare is 13.7, financials 12.5, consumer discretionary is about 10% of the S&P, industrials are 8, and on down the line as it goes down. So finally, when we get down to real estate, which is only about 2.4% of the S&P. And these weights, by the way, change every single month, and you have to go to spglobal.com to get the new weights, and you would put them into your scripts that way. So right off the bat, just looking at just the first chart, do you understand how you have an immense amount of market-generated information at your fingertips just right here? Before we even get into either of the other charts below, right? Just looking at this at a glance tells you an immense amount about how the market is trading and how strong or weak it is. If you see strength in the first two sectors, infotech and healthcare, that tells you a lot, because the market is obviously going to be a little bit more bullish than bearish with 40% of the S&P. But this particular day is very, very interesting because it's actually a lot of push-pull, which is a very sideways choppy day. And let's say that you were looking to do a futures trade, and maybe you saw a pattern that made sense to you for some reason, whatever, you saw a pattern in the ES or the NQ that you wanted to trade. I would say if you just took a quick glance at the 11 boxes here and you saw how extremely mixed the colors are, notice that there's 4 different colors here, it should cure you of any desire to want to take a futures trade at that moment, at least a directional type of futures trade. The type of futures trade that is more responsive, maybe, where you move up to a resistance point and you short there or you buy at a support, that may make more sense in this choppy environment because markets tend to not follow through when there's a lot of push-pull in the sectors, as you can see here. And on this particular day, there's an immense amount of push-pull in the sectors, like I said, with the 4 different colors. And what the colors simply mean is that if it is dark green, then it is greater than 0.50% up from the open. And that's very, very important. It's from the open, not from the prior day's close, which is really what makes these scripts really fantastic, because most of what trading platforms do is they just tell you what's going on from the prior day's close. And that has very little value if you want to know what the market is doing from 9:30 onward, because many stocks gap. And they gap, and if they just hold above the prior day's close, well, guess what? They are in the advancers column. So that's also why I like to tell people that these numbers here, which is the breadth and the advanced decline line, be aware that oftentimes they will not be able to help you in terms of the intraday market direction as much as something like your 11 sectors will here, or some of these other indicators, which I'll get into in a second, because these are measured from the open. So it gives you a much more accurate read about what is actually happening at the moment and from the moment that the bell rang. So anyway, and as I was saying, the colors are 0.5% up, for a dark green from the open, so greater than 50 basis. If it's just light green, it's anywhere from 0 to 50 basis. If it's dark red, it's down more than 0.5%. And then if it's light red, it's down somewhere between 0 and 0.5%. As you can see, the industrials here are down 30 basis, so it's somewhere in the middle. So in general, a quick rule of thumb, just right off the bat, is you will read the market so much better if you have these 11 boxes on your screen right away, and you know how the colors work and what you should be looking for. On a trending day, they're all green. That's a trending day up. On a trending day down, they're all red. If it's really a strong trending day in either direction, they're going to be all dark green. If they're a strong trending day down, it's going to be dark red. Okay, and this is very, very important. All the sectors will be pulling on the same oar, so to speak. They'll all be going in the same direction. Okay, but be very careful, as I was saying, of days like this where it's split, because you have an immense amount of push-pull. So whatever money is flowing into technology, for instance, it's flowing out of financials, and that's causing a problem, right? Whatever money is flowing into consumer discretionary, some of it is flowing out of real estate and out of utilities, okay? But you have to also keep in mind the weights. The weights are important. The heavy weighted sectors in the beginning are going to have far more effect on the S&P than the lighter weighted ones towards the end. Okay. Let's move on to the next chart. With this chart, this is our weighted AD indicator, and I really believe this is a holy grail of sorts for the markets. Basically, everything I just told you about these 11 sectors is illustrated graphically in this chart here below. So all of this is really this. And what this does basically is it plots a histogram on a 5-minute chart from the open of the percentage change of all of these sectors in the histogram. However, a percentage change that is weighted exactly by their weights. So that means that when technology goes up, it affects this histogram a lot more than if, for instance, real estate or materials went up, okay? So that's a weighted histogram of the 11 sectors in the S&P. And then this line here, the white line, which you can see here, it's kind of going through price here. The white line is the same 11 sectors. However, it is pretending that they're equal weighted. It's the same calculation, but it's calculating as if the sectors all had equal weight instead of the weights that they have. And this actually also tells you an immense amount about the market just in and of itself. For instance, if you look at this day here, which was the prior day, the yellow line is the demarcation between days. Look at how much stronger the unweighted sectors were than the weighted sectors, right? They never went negative. They were like positive the whole day, and they were all the way up here. But that's generally unsustainable. And if you look at the market on that particular day, and you can look at it actually right here on the 30-minute, this day right here is this day in the markets. Look what happened into the close. You had this rally throughout the course of the day that was, pretty lackluster. It's like come up to the 8, fail, come up to the 8 again, rally over the 8, and then look what happened in the last 90 minutes of the market. Completely just got destroyed. Why is that? It's because the leadership was weak. The leadership here by the white line is showing you that the leadership was in what? Was in energy, utility, material, real estate. It was in the lower weighted sectors as opposed to the upper weighted. If it was in the upper weighted sectors, then this line wouldn't be as strong, because remember, this is an equal weighted line. So it tells you that the smaller sectors were actually, kind of powering the S&P, and in general, that's just not sustainable, okay? Let's go on to the third box now, which is a nicey tick, but it's a special nicey tick. So I'm a big believer that the tick on the New York Stock Exchange is probably one of the most important market internals you can have on your screen. And it's also fantastic because it tends to signal very quickly and tell you what's going on at a moment's notice and give you good confirmation or not that a move is going to be sustained. Meaning that if the futures are moving up, the tick should be moving up. But more importantly, it's all about how much time the tick spends above what I call the zero line, or in this case, I call it the water line, because this is the iceberg tick. Obviously, it looks like an iceberg, and here's the water. What makes this so great is that it is able to show you at a glance very quickly the amount of time that is being spent above or below zero. And this is what people miss a lot about the NYSE tick or tick in general. They falsely believe that the tick is all about the extremes or where it goes or what number it is. And they think, oh, well, when you get a plus 1,000 tick, that must be very bullish, and minus 1,000 ticks are very, very bearish, right? Well, this is true to a degree, but it really oversimplifies what the tick does. What really matters in the tick is how much time is spent above and below zero to maintain that sustainability of a move. If the tick doesn't spend a lot of time above zero, and for instance, this is a good day to look at it because you can see that it's about 50-50, right? It's literally about half and half in terms of how much activity is above zero and how much activity is below zero. It's about 50-50. And lo and behold, look at what type of day you're having. Right? Look at the type of day it is. It's a grinding day. It's slightly bullish off the open. You're holding this rally off the open, which kind of makes sense, right? Because look at your histogram here. It's positive, and the weighted is above the unweighted. Here's the unweighted, here's the weighted. It's above. So it makes sense that it is a more bullish than bearish day. But if you look at the way that it's traded, it's also a pretty choppy day that can't seem to kind of get out of its own way. And the tick shows you that very clearly. You can very clearly take a quick look and say, aha, you know, this is really a day where there's equal distribution between upticks and downticks, and the amount of time being spent on either side is almost equal. So again, it tells you a lot about what's going on just at a glance. Thank you so much for watching. Let me just leave you with a few key points, if I may, which are really, really going to be important going forward. Firstly, understand that this is a very short video about a very, very large topic. The reading of market internals and understanding how those underpinnings work and how they push, pull, and play within each other takes a while to learn and understand, and it takes some practice. It's really important to kind of get yourself out of that mindset of just always staring at price and moving your focus over to those market internals instead. And within those three areas of that screen I just showed you, there's a lot of nuance that's not in this video. There's a lot to it, so just be aware of that. The second thing I want to say is that it's important for traders, if they can, to get as many screens as possible so that that information that I just showed you is separated from everything else, and it's always there at a glance for you without you having to maximize or minimize anything. I'm always amazed when I see people who tell me that they trade futures full time, and I ask them about their setup, and they say they have a laptop, and I say, well, are there any extra screens attached to it? And they say, no, it's just a laptop. And I know right away that obviously they're a very price-based momentum type trader, because with just one screen on a laptop, you have the price chart, you also have to have the execution like a DOM or whatever. It doesn't really leave much room for anything else. So I know they're not looking at any sort of market internals, and they're probably getting faked out by moves in the market a lot. So keep that in mind. I will say to newer traders, one of the best pieces of advice I can give you is invest in more screens. They're cheap and worth it. And I think you'll really see a big shift in your trading once you're able to see more at a glance really quickly without having to maximize or minimize anything. All right. Thirdly, the sidebar that I just showed you where I recorded the video, I have that up all day long in the weekly options advisory. And when I go live for live sessions, which is every day from anywhere from 2 to 3 hours of the beginning of every session, that's the screen that I'm sharing most. Even if I'm talking about an options play or individual stocks, I generally share that screen for all my subscribers just to show you how important I think it is. And that's really where I want everybody's focus to be. So if you check me out on weekly options advisory, it's just kind of a advanced heads up. You're going to see a lot of that sidebar screen, and then you'll see me be able to interpret it the way that I can and talk about all the different nuances that go along with it. All right. Lastly, all of the indicators that you saw are available at ShadowTrader.net, some of which are free but exclusive only to weekly options advisory, like those 11 sector boxes in the upper left where I started the video talking about the 11 boxes. That's a free script that I give only to subscribers of weekly options advisory. And then underneath it, the weighted AD is a premium script that we sell. That's the histogram with the white line. I do truly believe it's an absolute game changer. You'll see over time using it that I don't want to say that there's really a holy grail in the market, because I don't think there is such a thing as a holy grail, but if there is something close to it, it really is that indicator. And then lastly is the iceberg tick as well. The iceberg tick is also a premium script that we sell at our site. And I truly believe that if you put that on your chart, especially if you're a short-term futures trader, you're going to find so much value from that iceberg tick, because let's say you get long ES, and all of a sudden you can see that that tick is just not spending very much time above zero. It starts painting underwater very, very quickly. You're going to see that that trade is going to fail very quickly. You need the nicey tick to hold above the zero line in a sustained manner. And when it holds above the zero line and starts to spend time there, that's what causes the green paint to be painted above, and it just gives you a whole different picture of the bullishness that's happening at the moment. All right, so check all that out at ShadowTrader.net. It's in the store section, and all those indicators are there for you, and you can get those if you like and build your own sidebar and start to read the market like a pro.